Welcome back to Global Power Play, your go-to source for the latest global political news. This is our weekly recap, where we bring you all the biggest stories from the past week, covering key events from the US, Europe, and around the world. Sit back, relax, and let's dive into this week's most important updates. In a bold and strategic move, Amazon has announced plans to relocate its headquarters abroad, a decision sparked by the new trade tariffs imposed by the Trump administration. The announcement sent shockwaves through the business world, highlighting the vulnerability of global corporations caught in the crosshairs of shifting political and economic policies. What seems like a simple corporate decision is actually a far-reaching transformation that affects everything from global supply chains to the future of labor and innovation. Before we dive into the details, make sure to hit the like and subscribe buttons for more updates on global business changes and how they could impact you. At the heart of this upheaval is the aggressive stance on trade policy by the Trump administration. What were once minor tariff measures have evolved into sweeping levies affecting U.S. imports from key global trade partners. Amazon, whose success depends on its ability to source products globally at competitive prices, has found itself caught in the storm. Tariffs on Chinese goods, among other factors, have led to inflated costs, making it increasingly difficult for Amazon to maintain the prices its customers have come to expect. Relocating Amazon's headquarters abroad is a move born out of necessity rather than desire. The company's leadership has acknowledged that operating in an increasingly protectionist environment in the U.S. is no longer viable. As supply chains buckle under the weight of tariffs and global demand shifts, Amazon has made the strategic decision to plant its flag elsewhere. The choice of the new location is strategic. Proximity to key manufacturing hubs, a stable political climate, favorable tax policies, and a skilled workforce are all key factors in this decision. In addition to the business implications, Amazon's departure from its Seattle home will have far-reaching consequences for local communities. Thousands of workers who once thrived in the company's growing facilities now face the uncertainty of relocation or the possibility of seeking new opportunities. Small businesses that relied on the patronage of Amazon employees may see a decline in revenue, while real estate markets that once boomed thanks to the influx of Amazon talent may begin to slow down. Municipalities will need to reassess their budgets and possibly look for alternative sources of revenue to offset the loss of Amazon's tax contributions. For global businesses, this move signals a seismic shift. Amazon's departure will trigger a wave of competition among countries looking to attract foreign investment. Nations will now compete to offer attractive incentives, streamlined regulatory environments, and local talent pools to lure in multinational companies. As Amazon relocates its operations, countries in Europe and Asia will likely benefit from the influx of Amazon's jobs, investments, and technological expertise. As Amazon works to move its headquarters abroad, the company's logistics network will undergo a significant reconfiguration. New shipping channels, repurposed warehouses, and renegotiated supplier relationships will be key to ensuring Amazon's operations continue to run smoothly across the globe. This transition also presents an opportunity for Amazon to streamline its global supply chain, investing in new technologies and operational efficiencies that were previously hindered by tariff costs. Internally, Amazon is working to maintain morale among its employees and minimize disruptions during the transition. Employees who choose to relocate will receive generous relocation packages and support for adjusting to their new surroundings. For those who choose to stay, the company is offering career counseling services and working with local job markets to ensure employees can continue to find meaningful opportunities. As Amazon transitions to a new location, there are several challenges to consider, especially when it comes to adapting to local labor laws, tax policies, and cultural norms. Different countries have varying standards when it comes to worker protections, collective bargaining, and employment benefits. The company must ensure its compensation and benefits packages are competitive and aligned with its global mission, while respecting local regulations and norms. At the same time, Amazon is focusing on its long-term strategy by expanding its research and development initiatives and making new investments in automation and artificial intelligence. The company's vision for the future of retail and logistics includes autonomous vehicles, AI-driven inventory management, and enhanced supply chain optimization. While the US remains a major market for Amazon, the company is looking to diversify its operations and expand into emerging markets, particularly in Asia and Europe. If you found this video insightful, don't forget to hit that subscribe button. Stay tuned for more updates and content. We've got plenty more coming your way. For consumers, Amazon's move means faster access to products and services in new regions, but it also signals a shift in the broader retail landscape. As the company invests more in new technologies and logistics infrastructure, competitors may be forced to innovate more aggressively. Smaller businesses, particularly in the US, will need to adapt to this changing landscape, finding new ways to partner with e-commerce giants like Amazon or developing in-house logistics capabilities to compete on delivery times and cost. The move also prompts a broader conversation about corporate citizenship in a global economy. As companies like Amazon grow beyond the borders of a single country, their relationship with the communities they operate in becomes more complex. This globalized model of business is increasingly common, but it also raises questions about how companies measure their responsibility to their employees, customers, and the societies in which they operate. Amazon's decision to leave the US is a reminder that global corporations are no longer bound by national borders when it comes to making strategic decisions. As Amazon settles into its new headquarters abroad, the US faces the political and economic fallout of this major shift. Trade policies that prioritize short-term political gains over long-term economic sustainability could drive other companies to follow suit. The government must reevaluate its approach to trade and ensure that it creates an environment that supports businesses while maintaining strong global partnerships. Meanwhile, the global economy continues to adapt to these changes, with new trade alliances and supply chain dynamics emerging. Amazon's move is just one example of how multinational companies are recalibrating their operations in response to political and economic shifts. So what happens next? The evolution of Amazon's new headquarters abroad will shape the future of global commerce as more companies reassess their operations in the face of rising tariffs and political uncertainty. For consumers, the impact may be immediate, with changes to delivery times, product availability, and prices. For workers, it could mean more job opportunities in emerging markets, but also greater competition for positions in the US. When President Trump's trade war targeted Canada, the effects were far-reaching. It wasn't just about tariffs. These tariffs were shockwaves that rippled through the global economy. From steel and aluminum to even maple syrup, Canada found itself caught in the crosshairs. So what does a country do when its largest trading partner turns up the heat? Does it fold under pressure, or does it fight back? Canada chose something bolder: escape velocity. They turned to the world, forming new alliances, making new deals, and seeking new lifelines. The results? Well, some surprising nations stepped up to support Canada when the US stepped out. Let's break down how Canada turned this challenge into an opportunity and which countries are now quietly replacing America as Canada's closest trade partners. Number 10, European Union, EU. When Canada was cornered by US tariffs, its first move was toward a massive bloc with serious buying power, the European Union. Canada had already signed the Comprehensive Economic and Trade Agreement, CETA, years earlier, and when the tariffs hit, it paid off. Exports to Europe surged by over 25%, reaching tens of billions of dollars. Surprisingly, even small Canadian businesses found themselves shipping products to places like Amsterdam, Milan, and Stockholm. Why? Because Canadian farm products started replacing local goods on European shelves, and EU companies began investing in Canadian clean tech like never before. When the US raised barriers, Europe rolled out the red carpet, and Canada walked right through, never looking back. Number 9, Indonesia. One of Canada's fastest-growing trade allies wasn't in North America or Europe. It's Indonesia, the fourth most populous country in the world. In late 2024, Canada and Indonesia signed the Canada-Indonesia Comprehensive Economic Partnership Agreement, CEPA. This deal opened access to a rapidly growing economy that's projected to become the world's fourth largest by 2045. Canadian agricultural exports spiked and Indonesian investment flooded into Canada, especially in sectors like education and technology. Indonesia's booming middle class now sees Canada as a premium goods supplier. Canadian companies are flooding into Jakarta, Bandung, and Surabaya with everything from grain to green energy technology. When the West became too risky, Canada smartly shifted east, and the results are paying off in billions. If you found this video insightful, don't forget to hit that subscribe button. Stay tuned for more updates and content. We've got plenty more coming your way. Number 8. Ecuador, Canada's next unexpected ally. While it wasn't a superpower or even a major trading partner, Ecuador became a key player when Canada needed it most. In early 2025, Canada finalized its 16th free trade agreement, this time with Ecuador, a small country with a population of just over 18 million. Why did it matter? Ecuador is rich in sectors that Canada wants to grow: agriculture, mining, and clean energy. It also sits strategically near key Pacific shipping routes. Number 7. China. In the midst of tense diplomacy and high-stakes politics, trade between Canada and China didn't just survive, it thrived. In 2024, Canadian seafood exports to China tripled, reaching over $1.4 billion, making China one of the top buyers of Canadian lobster, crab, and salmon. China's demand for Canadian natural resources, energy, and agricultural products also soared. Despite rocky political waters, the relationship kept climbing. While the U.S. turned inward with tariffs, Canada looked outward, strategically engaging with China, which expanded its investments into Canadian clean tech. Additionally, Canadian universities saw rising enrollments from Chinese students. Number 6. Japan. When Canada needed to escape the U.S. tariff war, it didn't just look nearby, it looked across the Pacific. Japan became one of Canada's strongest trade partners, thanks to the Comprehensive and Progressive Agreement for Trans-Pacific Partnership, CPTPP. Japanese demand for Canadian agricultural goods skyrocketed. We're talking premium wheat, pork, and even frozen blueberries. Meanwhile, Canadian companies gained access to Japan's booming tech and electronics markets. The CPTPP boosted Canadian exports to Japan by 38% in the first 5 years of the agreement. Japan provided stability when the U.S. made trade uncertain. With transparent regulations and consistent demand, Japan quickly became a key ally in Canada's strategy for diversifying trade. Number 5. South Korea. Amid rising tensions, South Korea ramped up its imports of Canadian goods, especially agricultural products like beef, wood, and seafood. South Korea quickly became Canada's 7th largest trading partner. The partnership goes beyond raw goods. South Korea's booming auto and electronics industries began sourcing Canadian resources at higher rates. In return, Canadian firms accessed South Korea's advanced tech infrastructure, especially in clean energy and battery materials. Canada's lithium, cobalt, and hydrogen technology found a willing partner in Seoul. Number 4. Mexico. When trade with the U.S. became a minefield, Canada didn't just look overseas, it turned next door to Mexico. Under the Canada-United States-Mexico Agreement, CUSMA, Canada found stability in its southern neighbor. Mexico's support was essential, providing Canada with a lifeline when its trade relationship with the U.S. was in jeopardy. Number 3. The Philippines. Canada didn't just turn to economic giants. It looked to the Philippines, an archipelago of over 7,000 islands, and the results have been impressive. In 2024, Canadian exports to the Philippines crossed $2.3 billion, a 35% increase in just 2 years. Canadian meat, wheat, and fertilizers are in high demand, while Filipino companies are investing heavily in Canadian clean energy, agriculture, and education services. Number 2. Vietnam. Once seen as a low-cost competitor, is now one of Canada's most valuable trade allies in Asia. Since joining the Comprehensive and Progressive Agreement for Trans-Pacific Partnership, CPTPP, Canada's exports to Vietnam have surged by over 40%, reaching $1.6 billion in 2024. Number 1. Australia. Canada's long-standing ally, Australia quietly helped soften the blow from U.S. tariffs. Bilateral trade between Canada and Australia has increased by 30% since 2018, reaching $4.2 billion in 2024. The two countries have become important partners in sectors like pharmaceuticals, mining, tech, education, and advanced manufacturing. Conclusion: Canada's response to U.S. tariffs wasn't just about survival, it was about reinvention. From Europe to Asia, Latin America to Oceania, Canada didn't just weather the storm, it turned it into a global strategy. These 10 countries didn't just help Canada, they became its lifelines and partners, forging new paths forward in global trade. As the world continues to shift, Canada's story is no longer about what it lost, it's about what it gained. At 2:47 a.m. Beijing time, China's largest exporters received a directive: no more US dollar transactions. By morning, global markets jolted. Bond yields spiked, Wall Street braced, and the question arose, is this how the dollar loses its dominance? In April 2025, the Chinese Ministry of Commerce told over 400 firms to halt all new payments in US dollars. Within 72 hours, dollar-denominated trade volume dropped by 12.4%. Analysts saw this as Beijing institutionalizing de-dollarization. The yuan's share in global trade finance soared from 4.5% in mid-2023 to 7.6% by March 2025. China's push of the digital yuan into energy contracts signaled more than just a shift in currency use. It's a move for global power. The financial impact was immediate. U.S. Treasury yields jumped, with the 10-year bond climbing to 5.09%, its highest since 2008. Over $212 billion in treasuries were dumped within days, mostly from Asian sovereign funds and institutional investors. By March, China had slashed its U.S. debt holdings from $859 billion to $729 billion. This wasn't just a glitch, it was a signal. As Mohamed El-Erian warned, this shift could redefine global borrowing costs, with volatility in the U.S. bond market reaching levels unseen since March 2020. If Beijing treats the dollar as a liability, what does that mean for its dominance? Dollar dominance has been eroding for years. IMF data reveals that U.S. dollar reserves held by global central banks dropped to 57.2% in Q1 2025, from 71% in 2000. China's sudden halt to dollar settlements may have tipped the scales. It's not just China. Eswar Prasad, former IMF official, noted a systematic decoupling among BRICS nations and even some G7 countries. The yuan's use in cross-border settlements surged to 48% in March 2025, surpassing the dollar for the first time in Chinese trade history. On April 18, 2025, Saudi Aramco confirmed its first full oil shipment to India, settled in yuan, marking a significant shift. The reserve currency's decline happened slowly, transaction by transaction. But what is replacing SWIFT, and why should Washington be concerned? If you found this video insightful, don't forget to hit that subscribe button. Stay tuned for more updates and content. We've got plenty more coming your way. SWIFT processes over $5 trillion daily, but China co-developed mBridge with the UAE, Thailand, and the BIS Innovation Hub. Meanwhile, China's digital yuan now handles over $250 billion annually in domestic and cross-border transactions. This is operational, not just theoretical. At home, President Trump's response added fuel to the fire. On April 19, 2025, his Truth Social post demanded, "Cut rates now or we risk total collapse." Within hours, the dollar index dropped sharply and capital outflows reached $76 billion. The irony? Lower rates might stimulate short-term lending, but also erode long-term confidence in the dollar. El-Erian cautioned that such a move would accelerate the flight into non-dollar assets. For the first time in 40 years, the dollar lost value against the yuan, yen, and ruble. As Washington's fiscal policies weaken, Beijing rewires the global financial system. China's exports grew 8.9% year over year, while U.S. exports fell by 3.2%. Trade is no longer just economic, it's strategic. The U.S. economy contracted by 0.7% in the first quarter of 2025, marking 2 straight quarters of negative growth. Meanwhile, consumer credit card defaults spiked. The Fed faced a tough choice: raise rates and crush the housing market, or cut them and watch the dollar falter. The U.S. export sector also suffered, with Boeing facing $14.2 billion in order cancellations. Trade credit insurers slashed U.S. exposure limits. The U.S. didn't just wake up in a world with fewer buyers, it helped push them away. The real question now isn't whether the dollar is under attack, but whether it's being self-sabotaged. As China strengthens the yuan, America's own policies drive disinvestment. The next domino might not be a trade deal, but a global reserve currency shift. If that happens, the fallout will hit every American household. Is this the final blow to the dollar, or just the setup for something even more disruptive? Is the world preparing for life after the dollar, or is the U.S. sealing its financial fate? A single decision by President Trump to impose a 10% tariff on Canada's natural gas and energy exports has ignited a series of events that are reshaping the global energy landscape. This move, seemingly small at first, quickly sparked a dramatic shift, challenging America's long-standing dominance in the energy sector. And this shift didn't stop with Canada. In less than a month, over 180 countries felt the impact, and nations like Qatar swiftly redirected their gas supplies to Europe. To put it in perspective, the massive pipelines that previously delivered energy to states like Texas and New York are now being rerouted to powerhouses like Germany, France, and the UK. A new era of energy alliances is unfolding before our eyes. But what happens next? Will these changes trigger a major retaliation from Canada and Qatar? Could this force President Trump to reconsider his position? Let's take a deeper dive into how this chain of events unfolded and what it means for the global energy market. The tariff's arrival, a shock to U.S.-Canada relations. At the start of 2025, after being sworn into office for a second term, President Trump imposed a 10% tariff on oil and gas imported from Canada. This policy immediately set off a crisis between the two neighboring countries. Canada had been the largest supplier of crude oil to the U.S., providing nearly 4 million barrels per day. But by March 2025, this supply was now subject to a significant tariff, cutting into the economic relationship that had existed for decades. The ramifications were immediately felt. U.S. refining companies, already struggling to secure affordable and reliable sources of oil, faced even greater challenges. Meanwhile, Canada found itself searching for new buyers to make up for the loss of the U.S. market, where 90% of its oil exports had traditionally been sold. Canada's pivot to Europe and Asia faced with the tariff on its oil, Canada had little choice but to shift its energy exports toward Europe and Asia. This wasn't merely a reaction to the tariff, it was a strategic move. The energy crisis caused by the Russia-Ukraine war had already driven European countries to seek alternative sources of liquefied natural gas, LNG. By the first quarter of 2025, European LNG imports had surged by 23%, a stark increase from the previous year, and Canada had an opportunity to step in. Canada's response came swiftly with the expansion of its LNG export capacity. The first shipments from its new LNG terminal at Kitimat, British Columbia, are expected to begin in mid-2025, with the project capable of exporting 14 million tons of LNG annually. This was a crucial development for Canada, enabling the country to directly enter the European and Asian markets and reduce its dependency on U.S. customers. Qatar's strategic expansion and market influence. At the same time, Qatar, already a key player in the global LNG market, saw an opportunity to expand its influence. Known for having some of the world's lowest LNG production costs, Qatar wasted no time in increasing its export capacity. By 2030, the country plans to boost its annual LNG production from 77 million tons to 142 million tons, an 85% increase, aiming to supply both Europe and Asia. This wasn't just about capitalizing on the U.S.-Canada tariff dispute. It was part of Qatar's broader strategy to exert more influence over global energy markets. With the U.S. focusing on its own energy policies and Canada turning westward, Qatar has secured long-term contracts with European energy giants like Total Energies and Shell. These deals, worth billions of dollars, will allow Qatar to dominate the LNG market by the end of the decade. If you found this video insightful, don't forget to hit that subscribe button. Stay tuned for more updates and content. We've got plenty more coming your way. Europe's energy crisis and new alliances. Europe's energy landscape has been in turmoil, particularly since Russia's supply of natural gas to Europe was severely cut off in the aftermath of the war in Ukraine. With Russia's share of the European gas market dropping from 40% to less than 10% in a matter of months, European countries urgently needed to find reliable energy sources. This vacuum has allowed both Canada and Qatar to step in and form new strategic energy alliances with the European Union. In fact, Europe's LNG imports are set to rise by 25% in 2025 alone, as countries rush to replace Russian gas. Qatar has already secured long-term deals with European nations, including a major agreement with France's Total Energies for 3.5 million tons of LNG annually, starting in 2026. Meanwhile, Canada's role is growing as its LNG exports from the Kitimat terminal begin to flow into Europe. The U.S. energy dilemma. Despite its vast resources, the U.S. is now facing a dilemma. With gas prices soaring and domestic infrastructure under strain, Americans are feeling the effects. Gasoline prices in eastern U.S. states jumped by 20 to 40 cents per gallon, and the consequences are now being felt across industries. Major companies like Stellantis have shut down operations due to high energy costs, laying off thousands of workers. The U.S. government is scrambling to address this crisis by pushing for rapid upgrades to its energy infrastructure. However, with Canada and Qatar solidifying their positions in Europe, the U.S. risks losing its energy leadership on the global stage. The growing role of LNG in diplomacy. Today, LNG is no longer just an energy commodity, it's a tool of diplomacy. Qatar and Canada are using their energy exports to secure long-term strategic alliances with Europe, positioning themselves as critical players in the region's energy future. Meanwhile, the U.S. finds itself caught between maintaining its protectionist policies and embracing a more collaborative approach to restore its influence over the global energy market. What's next for U.S. energy policy? The future of U.S. energy policy is unclear. Should Washington continue down its protectionist path, or is it time to reconsider and open up to international partnerships? To regain its global position, the U.S. will need to invest heavily in infrastructure, both to meet the growing demand for LNG and to stay competitive in an increasingly multipolar energy world. Iowa remains a top agricultural state, ranking second in egg sales. However, the impact of trade wars, especially with China, has left many farmers here in crisis. The state's once thriving agricultural economy is now facing serious challenges. China's economic influence on U.S. GDP. China currently holds 4% of the U.S. GDP, a significant share. If China quickly liquidated its holdings, it could create immediate economic turmoil. This, combined with trade disputes, is inflicting severe damage on farmers, especially small family farms that are struggling to survive. Betrayal in rural America. In the past, rural counties in Iowa, Nebraska, and other Midwest states enthusiastically supported Donald Trump. But now many of these same farmers feel betrayed. Trump's tariffs, which were promised as protection for U.S. agriculture, have instead devastated the small family farms that once formed the backbone of American agriculture. Trump's protectionism has led to consolidation in the agricultural sector, with large farms absorbing smaller operations. The trade war's beginnings. 2018. The trade war began in 2018, with China targeting U.S. soybeans. China, once the largest buyer of American soybeans, imposed tariffs, leading to a collapse in demand and a sharp drop in prices. Farmers who had already invested in seeds, fertilizer, and equipment on credit were left with unsold crops. By 2020, farm bankruptcies rose 24%, and U.S. export losses exceeded $27 billion. The 2024 election, farmers still loyal to Trump. Despite the financial devastation, Trump's base remained loyal, believing the pain would be temporary. In the 2024 election, Trump won in 433 of the 444 farming-dependent counties, but the promise of a better trade deal has not materialized. Instead, Trump imposed another round of tariffs, even deeper and more harmful to small farmers. The toll of the new tariffs. This time, the tariffs are affecting small farms more directly. In the previous trade war, over 90% of bailout funds went to the largest 10% of farms, leaving the smallest farms to fend for themselves. Between 2017 and 2022, the number of farms under 10 acres fell by 14%. Meanwhile, large operations making over $2 million in annual revenue have more than doubled. The message is clear: support the biggest and let the smallest fail. Trade disruptions, the loss of global markets. The damage from the trade war continues. In April 2025, China canceled a 12,000 metric ton order of U.S. pork, the largest cancellation since the pandemic. Pork farmers in Ohio and Iowa, with no other buyers, were left with unsellable inventory. Soybean and corn growers were forced to cancel planting expansions as input costs surged by 40%. With no sign of recovery, the future looks bleak. A temporary truce, but no long-term relief. The temporary tariff truce in May 2025 brought a minor reduction in Chinese tariffs on U.S. soybeans from 125% to 10%, but Brazil, already a dominant supplier, has locked in long-term contracts. As a result, U.S. soybeans are now a backup option. The same shift is happening with corn, as countries like China and Mexico turn to Argentina for their grain supplies. If you found this video insightful, don't forget to hit that subscribe button. Stay tuned for more updates and content. We've got plenty more coming your way. A silent crisis, no bailout in sight. Unlike in 2018, there is no promise of a bailout for farmers this time. While Agriculture Secretary Brooke Rollins has suggested potential assistance, no concrete plans have been announced. Farmers are left to wait with no guarantee of survival. Small farms on the verge of collapse. Small farms, particularly those owned by women, Black, and Indigenous farmers, have been hit hardest. Between 2018 and 2024, Black-owned farms declined by over 8%, Indigenous farms saw a 10% drop, and female-led farms lost half of their revenue share. The latest round of tariffs is accelerating the collapse of these small operations, many of which have already gone under. Farmers speak out, a struggle for survival. Farm groups such as the American Farm Bureau and the National Farmers Union have raised alarms about the long-term effects of Trump's tariffs. Even the American Soybean Association has issued warnings that even temporary tariffs can permanently erase market share. Across rural America, farmers are organizing town halls, lobbying representatives, and fighting for their survival. The financial storm in Washington. A financial storm is brewing in Washington, and this time, it's not sparked by Beijing's military or cyber operations. Instead, it's coming from the bond market. In just 72 hours, Treasury yields surged past 4.5%, foreign buyers pulled out of Treasury auctions, and panic spread from Wall Street to Singapore. The White House's quiet rollback on China tariffs. Then, without warning, the White House reversed course on China tariffs. No press conference, no public negotiations. Just a quiet rollback. Why? Beijing was rumored to be preparing a far more destabilizing move, a Treasury sell-off. The signs of trouble. If you think that's speculation, the signs are already there. On April 9th, the White House suddenly removed electronics, machinery, and EV components from the tariff list. Officially, it was to shield American families from inflation. But behind the scenes, sources told Bloomberg that pressure came from a 28% drop in foreign participation at Treasury auctions. Just days before, the yield on the 10-year Treasury hit 4.5%, dangerously close to the 5% threshold that triggered last year's banking sector turmoil. The bond narrative is out of control. Treasury Secretary Janet Yellen reportedly held an emergency call with Beijing's diplomatic team, coinciding with the tariff rollback. According to J.P. Morgan's Phoebe White, the administration lost control of the bond narrative. When Treasury's panic policy was announced, the public saw a press release, but the bond market saw surrender. Japan's defensive move. Japan acted first. In February 2025, Tokyo sold $36.6 billion in U.S. Treasuries, its largest one-month sale in over a decade. This wasn't an ideological move, it was defensive. With Japan's central bank abandoning yield curve control, Japanese institutions sold U.S. debt to stabilize domestic bond markets and protect the yen. China's silent threat. If Japan, a U.S. ally, is unloading treasuries, how should markets interpret China's silence? As of March 2025, China's holdings of U.S. debt stood at $775 billion, down over 30% since 2018. While Beijing hasn't launched a sell-off yet, it doesn't need to. According to Barclays' AJ Rajadyaka, China's weapon is the threat, not the sale. The financial gun is loaded. No one knows if China will pull the trigger. If you found this video insightful, don't forget to hit that subscribe button. Stay tuned for more updates and content. We've got plenty more coming your way. The 5% yield problem. A 5% yield on the 10-year Treasury is unsustainable. On March 27, 2025, the yield briefly hit 4.96%, causing credit markets to seize. Mortgage rates spiked above 7.8%, and regional bank stocks plunged by an average of 6.2%, according to Goldman Sachs. The dollar's decline. The dollar index dropped 3.8% since January, and central banks from Brazil to the UAE are diversifying into euros and yuan while trimming dollar holdings. In March 2025, the IMF reported global dollar reserves at 57.1%, the lowest in nearly 30 years. HSBC's Max Keir stated, "The dollar is no longer the automatic safe haven, it's a volatility amplifier." Apple's strategic moves in China. Apple still relies heavily on China, with over 60% of its global assembly done there and nearly 95% of its silicon packaging routed through Jiangsu and Guangdong. Tim Cook's February 2025 visit to Beijing wasn't ceremonial, it was transactional. Insiders report that Cook used Apple's leverage in China to warn U.S. policymakers that a full decoupling could cost $21 billion in relocation and delay the 2025 product line. The bottom line: the truth is, some American companies are too entrenched in China to untangle without significant cost. What do you think about this case? Drop your thought in the comment and do not forget to like, share, and subscribe.